Good evening. Good evening. I am so glad that everyone had a chance to join this webinar today. I get so excited about these webinars because I get an opportunity to talk about home ownership and what I think about home ownership and what I know from home ownership. So I give you two perspectives, what I think and what I know. I've been in the industry for a while. And I believe I have a lot of information that I can share with you on home ownership that get muddied over the internet and talking to people who are not involved with mortgages. But hey, thank you for coming. But the first thing I always do when I when I talk about mortgages, I always like to talk about uh, health. I always like to give a quick synopsis on health because it doesn't do you any good to have the biggest house on the block or that dream home if you don't have the health to enjoy. So I'm big on mental health and I'm big on physical health. So even if you don't feel like you get out and walk a few miles or a few steps or something, but just get the blood going, and that helps us to think a lot about what we want to do in the future, what we want to do with homes, what we want to do with just life, period. I've been in the industry for over 20 years. I really want to tell people and share with people the reason I got in the industry is twofold. One is because of my mother, and I'll talk about that later, but I always also want to be transparent. There's a lot of false information that's going on about mortgages. A lot of people don't know, and some of it is not false, but some of it doesn't make sense. So I want to be able to explain that type of information to you. We're gonna go over a roadmap today, and I'm gonna try my best to give you some information that is pertinent to you, information that will help you maneuver through the process. Now, some of the information I'm going to give you today is some information that you've heard before, but hopefully I can say it in a way that make you want to take action. Now, take action doesn't necessarily mean I'm going to go out and buy a house. Taking action means doing what you just did today. You joined the webinar because you wanted some information about that. So I applaud you for that. We're going to break down the different mortgage types and fundamentals. My goal is not to make you a loan officer today, but I'm going to give you some information that you need to know. And then once we have a one-on-one consultation, I can go and break it down even further. And I'm also give you some information that you can go and use, go through Google or Chat GPT or whatever to make sure that you are that make sure that you are getting everything that you need. I want to make sure we talk about down payment assistance as well. That's something that's big, and a lot of people are not too familiar with down payment assistance, and they think it's the easiest thing in the world to get, but it's not. Bottom line, I'm going to talk about the bottom line, the importance of choosing the right lender. This is something that you will not hear from many lenders, but I'm going to talk to you about choosing the right lender. So let's get into everything. Let's talk about me. I've been in the industry for 20 years. I named the company after my mother. My mother was an honest person. She believed that everyone should have the ability to afford a home or purchase a home. And I've inherited a lot of her characteristics and traits. So I named the company after my mother. My company name is SCB Mortgage. Her name was SCB. So that's what I named the company. And I wanted to make sure that I lived her vision, her passion about helping people. And that's the reason I started this company. Now let's get into the mortgage fundamentals. What is a mortgage? A mortgage is just a financial tool that allows you to buy a home over time instead of paying cash up front. Instead of you having to bring two or $300,000 up front for a home, a mortgage was designed so you can make monthly payments over 10 years, 20 years, 30 years, 25, whatever you want to. It's no different than a car. You go get a car, you pay $500 a month for the next 60 months. It's your car. You have an interest rate, you pay the interest. You do all of that. The only caveat is you get the right to interest off on your home, where you don't get the right to the interest off on your car. Now, jargon. I mentioned the word jargon before. There's a lot of jargon that you're going to hear with FHA loan. I mean, with mortgages. You hear FHA, you hear VA, you hear jumbo loans. You hear a lot of different jargon, and I'm gonna try my best to stay away from that. But if I say something, put in the chat box, say, "Hey, Reggie, you said something that I did not understand." So one of the things that I think really hold people back from purchasing a home is there are certain hurdles that they think are holding back, but we can overcome those hurdles. Student loans, it's a hurdle, but we have a remedy for student loans. I have too much debt. Well, we have to look at your credit report and we can tell you how we can maneuver around that. I've only been on my job for 30 days. Well, we can maneuver around that. So I don't want you to be the critic of why you can't get a loan. My purpose is for you to bring your information to us, the expert, so we can tell you what you need to get a loan if you can't get a loan at this particular time. So those are some of the key takeaways when it comes to what a mortgage is. A mortgage is just a basic payment plan, but there are steps to get to the mortgage, and that's what we take you through. My job is to look at your unique situation and match it up with the right loan. That's basically what I get paid to do. The importance of preparing for finance. One of the biggest misnomers is that I have to have perfect credit score and I have to have 20% down, and I'll talk about that on another screen, and I have to have all these things to line up. That's not the case. The mortgage industry has made it so easy for a person to purchase a home now. It's unreal. The only thing that they didn't do is share with the public how easy it is to purchase a home now. That's it. Lowering your financing costs, better credit. So there are a couple of things that most people, the very first question people ask me is, what's the interest rate? Well, the interest rate depends on your credit score, depends on your debt to income ratio. Your debt to income ratio is how much money, your gross income that you make divided by your monthly bills plus the mortgage. That's what your debt to income. We don't want you to go over 50% debt to income, but we can take it all the way up to 56.99. So let me explain that again. Your gross income, not your net. If you make $60,000 a year, you divide that by 12, that's $5,000. If your monthly bills and everything you pay is $2,500 a month, where your debt to income divided by 5,000 is 50% debt to income. So that's how we calculate your debt to income. We can boost your debt to income and we can boost your credit score by, we may have to pay some things off. And if we pay some things off, so let's say we paid, instead of you paying $2,500 a month, we paid something off and you're only paying $2,000 a month. Now your debt to income drops to 40 something. So that means you can afford more house. So there are different ways we can do it. That's how we increase your buying power. If there's a hurdle with your credit or your DTI, we take the time to work with you and fix that. We want to put you in the perfect situation so you can buy the perfect home that fits your needs. Now, here goes some things that I want to demystify. When the underwriter looks at your file, there's no magic behind the curtain. They only really look at four main pieces: your credit history, your debt to income, your employment, and assets and savings. Your credit history, we have to look at that. I can close you. I can get a loan for you with a 500 credit score, but it's going to be tough. You're going to have to put more money down. So I don't want to start you there. I can get you one at 600 or 620, 640. I would love for you to be around a 660 or higher to get a credit. But if you don't have that credit score, I want you to still come to me so we can evaluate. It is better to get a loan with a 620, 580, or 640 credit score opposed to paying rent for another year. So let me give you an example. If you pay $2,000 a month in rent, That's $24,000 in 1 year that you're not getting a write-off that you're giving to somebody else. If you're there for 2 years, that's 48,000. If you're there for 3 years, that's 72,000. Why not put that $72,000 into your home, to your own home? You'll get it back at the end of the year. Well, you get a write-off at the end of the year for the taxes. So I don't want you to think that because you see something that comes in from your Capital One credit card or your Chase credit card saying your credit score is 580 or 600, we need to look at your credit report because we have a different credit scale that we look at. Number two, debt to income ratio. I already spoke about that. We look at your gross income divided by your monthly payments, not your monthly balances, but your monthly payments. And that gives us your debt to income. Now, here's one caveat. We calculate your income based off of gross income, but you only spend or you only bring home net income. The reason I want to stress this, and I really want you to understand this, you can't spend gross. You can only spend net, but we calculate your income off of gross. So if you qualify for a $600,000 house, but you're more comfortable with a $400,000 house, I'm going to try my best to steer you to that $400,000 house. I'm going to give you all of your options, but let me share with you why I don't want you to go to the top of your limit. Because once all of the novelty runs off and that 1 month go by and 2 months go by, and you got to realize you have to make a mortgage payment that's extremely high, that's why I don't want you to go for the top of the rung if you are not comfortable. Need to be somewhere in a comfortable range. Don't want you to work 2 or 3 jobs just to pay a mortgage either. We'll look at your file and tell you what's best. I'm gonna tell you what you qualify for. I'm gonna tell you for what I'm looking at, what's comfortable, and then you're gonna tell me what you think is comfortable, and I'm gonna present all 3 to you. That's why I'm so passionate about giving you the information up front about that income piece. Your employment, most people think you need to be on a job 10, 15, 20 years. You could be on a job for 30 days. We only look for gainful employment. What that means that you've been employed for the last 2 years. You could have had 20 jobs in the last 2 years. We just need to make sure that you've been employed. Now, if you have a gap in there, you can explain the gap. Someone got sick, you got laid off, whatever the case, we can explain that, and then that will take care of that gap. But we need at least 2 years of employment. If you're just graduating college and you find a job in the career that you studied in college, we can use that as part of your employment. So there are many different ways to get you a loan. Assets and savings. I'll mention this again on the down payment screen, but on assets and savings, you have to bring some money to closing. Some money will come out of your pocket. I don't care how much money you get in grants and down payment assistance, you have to pay some money. So do not get caught up with, oh, this person got 20,000, this person got 30,000. There are some attachments that come with that down payment assistance, and we'll talk about that later. I don't want to discourage you against it. I'm just giving you the nuts and bolts of it. Key terms. You're going to hear a lot of things. You're going to hear interest rates and APR. Most of you all just want to know the interest rate, but then you'll see the APR. The interest rate is the interest rate that you'll pay for life if you have a fixed interest rate. A fixed interest rate, if I tell you have a 6% interest rate and you don't refinance, you will have a 6% interest rate for 30 years. The APR is the interest rate plus the amount of money that for closing costs and money that you paid the lender and all those little fees that come into closing a loan. So it's actually the money that you use to close the loan plus the interest rate. That is something that the government wanted us to make sure that every time we talk about an interest rate, we have to include the APR. But monthly, you pay the interest rate. That's what you pay. You don't pay the APR. Fixed rate versus adjustable rate. A fixed rate is just that. Like I said, you pay the exact mortgage, principal, and interest for as long as you have that loan. Now, there is a caveat to that. When you're paying a mortgage, you're paying mortgage, you're paying the principal, you're paying the interest, you're paying insurance, and you're paying taxes. The taxes depends on what locale you live in. If you live in Richmond, if you live in Sarasota, Florida, if you live in Henrico, Virginia, or you live in Tampa, Florida, each locale have a different tax bracket or different tax rate that we have to assess the property with and add that to your mortgage. Same thing with insurance. You go out, you find your insurance, they tell you what the premium is, they put that in there. So your total mortgage payment is principal, interest, tax, and insurance. That's what the fixed and that's the fixed rate. Adjustable rate is the one you're still going to have the principal, tax, and insurance and homeowner principal, interest, tax, and homeowners insurance, but the rate will change after a certain period of term. We have a 3-year, 5-year, 7-year, and a 10-year. So after 3 years, your interest rate will fluctuate compared to what the industry is saying. 5 years, the same thing. There are many people who get a 3-year because it's a 3-year, 5-year, 7, or 10-year adjustable rate. They get it because the interest rate is a little lower, and then they're hoping that the market change by the time it matures, and then they can refinance into another adjustable rate or to another loan. Loan terms. Talked about this. We can get you a loan from 10 years, 15, 20, 25, 30, whatever you want. You don't have to get a 30-year loan. If you get a 30-year loan, your payments will be much cheaper. If you get a 15-year loan, your payment will be much lower, but you pay less interest. The 30-year, you will pay more interest. 30-year, take a loan to pay off. 15 years is shorter to pay off. But we have a workaround. If you get a 30-year and you make some extra payments towards your principal, you can knock that 30-year down to 25 years, 22, 23 years. So there are workarounds. PMI, escrow, and DTI. I've already talked about DTI. I'm not going to talk about that again. PMI, the reason you can bring 3%, 3.5%, 5% to closing is because of PMI. That's private mortgage insurance. Back years and years ago, you had to have 20% to put down. So what the bank said, or the smart people that's running our country, or lack thereof, they came up with, if you pay an insurance policy for the bank in case you default on your loan, you don't have to bring as much money. So what a PMI is, you're making a monthly payment towards an insurance policy to protect the bank in case you default on your loan, and the bank will get their money. And then in that case, they don't have to ask you to bring 20% to close. It's a fantastic program. I love it. Escrow is the insurance and taxes that I talked about. They will put it in an account, and whenever your tax and insurance are due, the bank will pay it for you. This here, types of mortgages. There are many types of mortgages, and I always use this example. You can have you and your coworker work at the same job, make the same salary, have the same credit score, buying the same house right next to each other in the same city, and get 2 different loans. There's a loan for everyone, and there's some maneuverability inside each loan to make it work for each person. I don't want you to think you're pigeonholed into one type of loan. This is just a few loans. There are many different loans out there, but this is what we do to make sure we get you into a job. My entire job is to sit down with you, look at your unique financial fingerprint, and figure out exactly which one of these loans fit perfectly for your life. You just tell me the goal. My job is to put it together for you. Now let's talk about down payment assistance. I know I'm going a little fast, but I really think you'll get more of it when we have this one-on-one. Down payment assistance, it's good. They have some attachments to them where you have to qualify. First of all, remember earlier when I told you have to qualify off of gross income? Well, with down payment assistance, that means you have to qualify off of net income. So there's 2 different calculations. So I may tell you that you can qualify for a $400,000 house, They may tell you can only qualify for $325,000 because they're using a different income. They generally want you to have a higher credit score, 620, 640. I can do 600, I can do 580, I can do 500. Down payment assistance works in conjunction with me. You will go to certain localities or certain community centers, and they will have you to go through a class. Once you go through that class, they give you a certificate, and you bring the certificate to me, and then we can get you down payment assistance. Down payment assistance also means you have to stay in that loan for a certain amount of time, and if you don't, you have to pay that full amount of money back. It's usually 5 years. Someone told me they moved it up to 10 years and 15. I have not verified that. All I know is a 5 year. They are good for certain people and they are not good for other people. Interest rates tend to be a little higher on down payment assistance. Now, I know I told you all the bad things about down payment assistance, and again, I'm not trying to talk you against it. The good thing about it, if you don't have the money, they can definitely give you the money and help you out with that process. So that is the good piece of it. There's other alternatives that we use in lieu of down payment assistance as well. The bottom line, even with those extra rules, it's absolutely worth pursuing down payment assistance. There are a few extra underwriting hoops that we have to jump through, but we can definitely make it work if it needs to work. But I will present both to you. Hey, I think down payment assistance will work, or I would say, hey, I think I can get you a little more with this type of loan here. This screen here, why shop around matters. Many people will not tell you to shop around because they want you to come to them. I want you to come to me as well, but you don't know me and I don't know you. We have to build a trust, and you have to trust me and I have to trust you. You have to like me and I have to like you. And I feel so confident that the customer service that we have, the transparency that we have, all of the numbers and things that we figure out for you, I feel like, or well, I know that it's not something that we are misleading you or misguiding you on. So that's why I am not opposed to a person going out looking and talking to other loan officers. This is what I would like for you to judge them by, though. We all can pretty much do the same thing. Interest rates are pretty much going to be the same, maybe an eighth of a difference or something like that, give or take, but we're pretty much all the same. It's the customer service. Are they going to pick up the phone when you call? Are they going to work hard for you when they run into a hurdle that we spoke about on the other screen? Those are the attributes that we attribute to working with clients. I'm not so keen on many other companies that do that. Now, some other companies will, but you have to feel comfortable with working with the person. Somebody's going to pick up the phone 10 times if you call 10 times with 10 questions. Somebody's going to pick up the phone at 7 o'clock in the morning before you go to work because you can't talk while you're at work, or someone's going to pick up afterwards. That's what sets us apart. Now, many people think banks are the best place to go for a loan because they're a big old building and they have all of this behind them. But banks, I used to work for a bank. Banks are not the best place to go for a mortgage. There are many different reasons. One, the interest rates are a lot higher. Two, they take 30 to 45 days to close your loan. Three, they are cut and dry with the guidelines. Rarely will you see any exceptions to the rule to try to help you get your loan through. So those are some of the ins and outs. I always like to tell people this: always get you what's called a fee sheet or a loan estimate from the other company. Now, many people are going to put the lowest numbers on there. And that's why I'm always asking you to have them to go through every line with you. We will go through every line and explain what this is accurate, this is a fact, this is an estimate, this is this is that. That's the only way that you'll feel comfortable and get a handle on what's going on with your loan. When you shop around, I want you to actually ask those other guys And don't even hesitate about that fee sheet. That needs to be the first thing that you ask them. And then you can compare side to side. And then call me back and say, hey, Reggie, they look a little better here than you do. And I can say, hey, they fluffed that number, or that is a good number. Let me see why his number is better than mine. So that's why I want you to shop around. Here goes some common questions that are asked. What is a realistic estimate of cash I will need to close? I don't know. It depends. It depends on when I look at your file, look at your credit score, look at how much money you make so I can get your debt to income. Um, uh, Closing costs for a person who's moving to Richmond, Virginia, opposed to moving to Henrico is going to be different. If you close on the 15th of the month and you close on the 16th of the month, that's going to be different. But we do have estimates we give you. We project. We got some hard numbers that we know going to stay, and there are going to be some other numbers that's going to change when depending on where you move and where you and how soon you want to move. Can you send me a fee sheet, loan estimate, explaining numbers? Absolutely, that's what we do, and that's what I want you to make sure you ask me and ask the other people as well. Is the rate you're quoting me fixed or adjustable, and what does that mean for my long-term payment? I always explain fixed and adjustable. I always lean toward fixed, not because it's a better one, it's because it's one that people are most comfortable with, but I talk to them both. Most people are, I don't want to adjust a rate. What if it moves on me 5 years from now, 10 years, I'll forget. Well, it's my job to make sure you don't forget. So I will say, hey, your loan is getting ready to adjust. But I always talk about both of them. From the moment my offer is accepted, what is a realistic timeline reach the closing table? It depends on who your loan officer is. It depends on what company you went to. I just closed a loan in 15 days. It was a purchase. Actually, the lady went on vacation. She was over in Portugal and she came back on the 11th, but we closed on the 10th because her husband did a POA and he signed for her. I had another guy that was in the military. He was over in Germany. We closed him in Germany. So you don't have to be at home. We can send a power of attorney, not a power of attorney, a notary to close you. So, but a realistic time frame is how fast you can get documents to me. My team is going to do what we're supposed to do. But generally, a lot of times, and I hate to say this, it depends on how fast a client can get us the documents that we ask for. I generally ask for as much as I can up front so I don't have to come back and forth, but it's time we will have to come back and forth. What are the most common issues that could delay my closing date? Clients not getting us documents that come on time. We can have a closing date that's delayed because the appraiser found something with the house and we need to get the home fixed and the seller is not willing to fix it, or it takes a while before the seller. So those little things, but we try to get that early in the process. We try to get the appraisal out there the first week. So if anything comes up, we can mitigate that right away. Now, here's the path to home ownership. It's a simple path. I always tell people it's simple, but it's not easy. But it's up to me to make sure that we get there and it seems easy to you. I always tell people, I'm your lawyer, I'm your priest, and I'm your wedding planner. I'm your lawyer because I need to make sure we get everything done correctly. No one's going to jail. No one's making up stuff. Everything that's there is correct and we submit it. I'm your priest because you need to tell me everything. This is one of the things that hold up loans as well. When the client does not tell us everything and we find it, the underwriter finds it. So now in the underwriter minds, they're thinking deception. So they're looking at everything a little tight now. They're scrutinizing things. If we know it up front, we can fix it or explain it to the underwriter and we can go. So I need to know everything up front. And then when I say I'm your wedding planner, when you get married, all you want to do is get married and go. You don't want to sign no checks at the wedding. You don't want to worry about if the band is there. You don't want to worry about if the preacher is there. You want to get married, go on your honeymoon. That's what we do. We take care of everything. All you have to do is just go. Now, I know I went a little fast, and when we have a one-on-one, we can go into more deeper understanding of how this mortgage piece works. But the main thing, the very first step you've already taken about showing up today. The second step is to set up an appointment and talk with me. And I have, let me get I'm gonna put it in the chat box. Let me see what I can do. I want I want to make sure that you can get an appointment with me. And all you have to do is just click on it. And then once you click on this, it will set up an appointment. And I will uh, talk with you. Let me put it in there now, chat. Click on that link, and you can definitely come to set up an appointment, and we'll go over a one-on-one session. We'll give you a roadmap, a guideline of where you are, what you need to do, how long it's going to take, and we're going to follow up each step. Many of you all are ready and don't even know it yet, but you're already ready. Oh, I got a question that jumped into one of my chat box. Credit scores, minimum down payment. Credit scores, again, 620, 640. I would love for you to be around 660, but we can get you done at 580. But there are a little more hiccups. We can get you into a loan with 3.5% down payment. That's 3.5% of the purchase price of what they're selling a home for. If you're looking to move in a rural area, USDA area, you can move into a home with no money down. If you're a veteran, you can move into a home with no money down. We also have a program where we can give you it's two mortgages and it's 100% financed. Interest rates are just a little bit higher, but that program helps a lot of people get in without any down payment money, and they also give you a portion of your closing costs. So basically, you just need a little bit of closing cost money. Also have a question, timing the rate market versus buying now and refinancing later. I'm glad you brought up refinancing. I'm glad you brought up rates. I think it's always the right time to purchase. The reason I say that is because when you're renting, you're paying 100% interest. You don't realize that. You're paying $2,000 a month, you're paying $2,000 a month. You don't get to write any of that interest off at the end of the year. But guess who does? Your landlord. When you own a home, I don't care if the interest rate is 10, 12, 15, or 20. It's not, excuse me, it's not that high. They're in the sixes and some in the fives, but at least you get to write it off at the end of the year. And you remember I told you at $24,000 that you're paying and the 48 and the 72,000 that you're paying the landlord, that money is going towards your house and you get building equity in your home and you get to write it off at the end of the year. So I don't think it's a right time to wait. No one knows what the market is due. No one has a crystal ball and say interest rate's going to drop. Interest rates are like the gas. When you go to the gas pump, one day is this and next day is that, and sometimes it changes. That's how interest rates are. So here's another misnomer. Whenever you hear on TV the Fed funds are dropping the rates, those are not for mortgages. Those are for cars and credit cards and personal loans. Those are not for mortgages. So whenever you hear that, even though you may hear people, oh, that's it, it's not. Mortgage rates change every day. What else? Oh, what are some hidden costs first timers miss? Well, there are no hidden costs, period, on what we call the loan estimate. The government has put something in place. Every dollar that's charged has to be on that form and you have to see it. But this is where most people think that when they hear closing costs, they think all the money is coming to the lender or the broker or the bank. It's not. You have many sections on it. You have sections for the title company, that's the attorney that works for you. You have to pay them, and they go and do the title search and make sure the house is clean for you. You have to pay the city or the county that you live in. Those are taxes. You have to pay insurance. There are a myriad of sections on there. It's not a lot, but all of that goes into purchasing your home, and those are all of the costs. None of them are hidden. You have about 15 people working for you when you purchase a home. You the boss. You have an appraiser working for you, loan officer assistant. You have a processor. You have an underwriter. You have a myriad of people who are working for you when you're doing loans. So I thank you for joining this call today. It was a wonderful time speaking with you. I would love for you to click on there, set an appointment. Let's talk. If you have any questions, you can text me. My email is right there. You can also call me. Whatever's your preference of communication, that's my preference. If you look on my Calendly, that's the link I put in there. I start talking to clients at 6 in the morning because I know you may have to talk before you go to work. You may only have a 15-minute lunch break. And I talk to you after work, I think to 8 o'clock and sometimes longer. So don't feel like you have to talk to me through 9 to 5 and on your lunch break, whatever is comfortable for you. I really enjoyed it. Thank you. If you have any questions, again, please reach out to me, Reggie Ford at scbmortgage.com. And please visit the website. We have a mortgage calculator on there. If you got any questions before you want to come to me, mortgage calculator. We got some questions. If you got questions, we can answer. We have a chat bot on there. You can put any questions in it and answer that chat bot would answer the questions. We have a lot of different tools on that website. So if you want to go to the website before you call me, that's perfectly fine. I look forward to speaking with you. I enjoyed it. Thank you.